Excellencies, ladies and gentlemen, good morning. It's an honor for me to be here this morning, and I hope that my brief introduction will set the stage for very interesting discussions in the annual debate that will follow, and which I am myself looking very much forward to. As Lanhor was saying, the global economy is quite risky at the moment, and I would say that many countries are highly vulnerable. However, with risks and vulnerabilities also come opportunities, and hence what I would like to do this morning is indicate some of the challenges that are facing the global economy and Africa in particular, but also point to some opportunities that, if correctly managed, can help the continent continue to grow at a rapid pace. The deceleration in the global economy that we are seeing now is primarily led by fixed investment due to growing anxiety, concerns about the future, prompted not only by the trade war, but also by the end of fiscal stimulus in the US. Brexit concerns in Europe would add to those concerns. And you see on the chart what we call the Purchasing Managers' Indices, the PMIs, which clearly have been pointing downwards for advanced economies for nearly a full year now. In African countries where we also follow PMIs and hence track confidence in several countries across the region, we have more diverse trends showing, but in general, we also see today this deceleration trend in confidence, which indicates that there is definitely awareness of the difficulties to come. At global level, we just mentioned the OECD, IMF forecasts. Ours is not very different. We also foresee a deceleration in global growth coming down from 3.3% last year to 3.2 last year, down to 2.7 probably in the coming years, with a deceleration that is primarily occurring in advanced economies and China. So today we are seeing many emerging markets more or less able to weather the downturn, but clearly risks are ahead, and I'll come back to them in a moment. So slowing growth overall, but in this context of slowing growth, we still see the Africa region as a whole being the second fastest region in the world if you look at the whole period 2000 to 2024. So second fastest growth region after Asia. And despite slowing down in China and possibly other countries in the region, with the creation between 2018 and 2023 in terms of new value added created, the equivalent of Belgium. So in real terms, there is growth there. There's a big economic potential that is presently in the making, and that will probably lead the continent towards stronger growth going forward. I say stronger growth, but nevertheless, the 3.7% forecast growth that we project in the coming 6 to 7 years are much below what we had seen before the global financial crisis, and hence indicates already some of the difficulties that countries will have to be coming up to terms with in order to continue thriving in this difficult environment. Risks are many. At the core of the risk system, and we still put it as a risk instead of a realization, is the trade war. Why is it still a risk, although many measures have already been implemented? Because we see, I would say nearly every week, that another tweet threatens for more tariffs to be imposed on certain countries. We have an obvious trade war with China that started a year ago, tariffs on aluminum and steel. We have the threat of tariffs on autos, auto imports into the US, which would be very negative for Europe and Japan, but also South Africa. And we also have threats now of tariffs applied on Mexico. Why are these that relevant, apart from the fact that they lead to slowing trade? They are very relevant because they can trigger not only a slowdown in China, but possibly a hard landing in China if the next wave of tariffs is imposed, which could trigger a next global financial crisis, because China has been more or less compensating the impact of tariffs by letting its currency depreciate, which offsets to some extent the impact of tariffs. But clearly, in having the renminbi depreciate, other Asian countries have also started letting their currency depreciate, and with the worsening of the global conditions, and in particular the more difficult situation in Asia, we would see speculative movements against currencies, and any country exposed or dependent on foreign capital would be taken into the storm. So many risks that basically can accumulate and really lead to the concerns that today trigger a slowdown in investment. So what are the specific challenges for the region and opportunities that I wanted to highlight? On the challenge, one of the first ones to mention is the commodity dependency of the region in a context of continuing low energy and commodity prices. We can also mention the slowing import demand, and you will see how much that impacts the region. Namely, however, competitiveness can be enhanced through a number of measures, including trade agreements. There is overall a slowing trend in global demand addressed to the countries in the region. And the high debt burden is the third challenge that I would highlight this morning. But all these challenges bring their own opportunities. The challenges above have the difficulty that they either are not controllable, there's not much you can do about slowing global economy. There is a lot that can be done about opportunities, and there is a lot that can be done about policy making to ensure that those opportunities are fully tapped into. Opportunities are in particular the fact that with growing fears in Asia due to the trade war, we see as external observers a much bigger emphasis on Africa as a potential for investment. The number of events, of discussions, of the debates has increased tremendously. There's a lot of attention to the region as being possibly the next big area to invest in, given possibly slower prospects in Asia. There is still abundant liquidity, which makes also this increase in investment possible, and the prospect of increased regional integration is clearly a plus. So to quickly go over the challenges, to come back to the opportunities in more detail, when I mentioned the low commodity prices, we know that many countries in the region are highly dependent on commodities as exports. And in fact, 18 countries of the 54 presented on the chart have a share of GDP, not exports, generated by commodity exports in excess of 20%. This means that if commodity prices fall by 10%, and we have seen a lot more than that lately, it knocks off immediately 2 points or more from those countries' growth. So that's a real challenge, and unfortunately, the forecasts for commodity prices going forward are not pointing towards a recovery to the high levels we saw around 2012, 2015, because the slowdown in global growth is leading to less demand for commodities. And this is accompanied by a shift from manufacturing to service-based industries or sectors, including in China, which means that the needs for commodities is actually decreasing globally. So commodity prices are not going to be improving much. Diversification is needed. And oil prices are not going to be moving up much either, and this despite sanctions on Iran or other factors, geopolitical including, that could temporarily bring a little boost in prices, because the US, as you know, has become the supplier of last resort in a way, stabilizing the market, and each time prices go up a little, we find US production increasing and hence keeping a lid on oil prices. The trade is another important factor. On the left-hand side, you see the index, so the trend in world trade, which increased quite rapidly in the beginning exit of the financial crisis, then posted a steady growth, lower than GDP, but about 3.5% in the past years. And if you see at the top of the chart, it's now stagnating. Yes, it's sometimes growing a little, sometimes falling, but in effect, we see global trade at a plateau. And this has big implications for African countries in the sense that the demand addressed to those exporters is not growing very fast. And if anything, it's actually growing half the rate it used to because of the importance of China as an export destination for many countries. So the right-hand side that you see there shows the trade-weighted index of demand addressed to Nigeria, Angola, and South Africa. And you see that whereas Nigeria and Angola saw growth in demand addressed to them by 8% last year, this is now going to be halved to 4% only. So more competition expected to fight for markets that are still growing, but not growing as fast as before. Exports to China are a particular concern. Again, high exposure of some countries, including Angola, to China. And China is slowing. And this graph shows how much, if you compare the top line to the median line, green, it shows the revisions in our forecast for China between February 2018 and this last month. So it has already come down. Maybe the slowdown today is not that visible if you look at the data that is coming out, but there is a trend and it's a lower forecast than we were seeing even a year ago. If the trade war escalates and we see a widening of tariffs applied to all China imports, plus what will likely happen as a result, a fall in global equity prices, China's growth could come down as much as to 5.5%, because it would not only suffer from lower trade to the US, but it will also see the impact of collapsing equity prices, lower investment, foreign investment into China. Why would you invest in China if you're going to be exposed to tariffs? And this will all aggravate the downturn. So a second challenge is the external debt burden. The external debt burden has increased quite a lot because liquidity conditions were very easy and interest rates low, and that has caused several countries to be highly indebted and also to put themselves in the situation of being dependent on continuous inflows of foreign capital. Again, and we will be distributing the slides after the meeting, a number of countries combine a high current account deficit due to low commodity prices and a high fiscal deficit, which needs to be financed from capital flows, which increasingly come from abroad. So that's the second key challenge. And shifting on to the opportunities, we have FDI being clearly an opportunity for two reasons. One, as I indicated, is kind of a lack of decrease in interest for Asia as a destination for FDI because of the trade war, and also because of the big growth opportunities that we have in the region, which could really contribute to much faster growth going forward in a high liquidity environment. Third opportunity, trade liberalization. As was mentioned, the Africa Continental Free Trade Agreement is a big opportunity for the region in helping to diversify the growth, become more competitive, help companies to benefit from economies of scale. This could definitely spur accelerated growth and lead to exchanges that go beyond the regional economic communities that exist today and create just a broader market on which to trade, kind of like what the European Commission was doing in its early years. So many countries, as you know, have ratified the agreement, and there will be challenges ahead, of course, which I won't dwell onto, but it's definitely an opportunity that has to be tapped. So to conclude, yes, there are some risks. Unfortunately, some of the risks cannot be managed. trade war. There's not much anybody can do about it right now except President Trump and President Xi Jinping. The external debt that has accumulated is there. It's a legacy of the past. But what can be done going forward is to manage those risks correctly and create a favorable environment for businesses. Public finances cannot derail. The debt is a problem that has to be reduced going forward, if only to increase investor confidence. Reliance on external financing has to be managed very carefully, and the high vulnerability of some countries to natural disasters also has to be reduced, because it does create cycles independent of the global cycles that can be very unfortunate. So that means infrastructure investment. And finally, One Belt, One Road, which I have avoided mentioning until now, can be an opportunity, but again, it's careful management and definitely avoidance of nationalization of resources in order to pay back the debt. So I will stop here, as I just want to conclude with an optimistic tone, which is that these opportunities are real, but they do have to be managed, and so I'm sure the rest of the day will contribute to this discussion. Thank you very much for your attention.